Okay, thanks again for your promptness, your punctuality. We now have Tokyo and Sydney online, so welcome to Shoda-san and the team in Tokyo. Can they see us?
They can see us.
Oh, that's very clever, isn't it? And also to the team in Sydney. I know Neil's here, but a number of our other Sydney team members are video streaming up in our Sydney office as well. And thank you all for joining us here in Melbourne. The purpose today is to share with you the background to the result of and the plans around our 3-year business plan, and in particular our plan and targets for this next year coming up. And my very clear objective in doing so is to make sure that we combine what is otherwise a brilliantly and uniquely designed business with an enormous capacity to also execute. And that execution will be enhanced if we all understand what success looks like and our role in it, and therefore are aligned to it and actually all day, every day contributing to it. And as a result, I genuinely hope and believe that this time next year we'll be looking back on the year that was and saying that was a stellar year. And as a result of that, our clients are happy, our shareholders are happy, our staff are happy, and all of us individually benefit as a result of that. So that is the unashamed intent, to get to that time, this time next year, and be in that position, and hopefully through the knowledge and advocacy that will come about through the understanding from today's briefing. So I'm going to walk through a little bit of the background to the plan and the plan itself, and then a number of other members of the leadership team are going to jump into some of the initiatives that they are the owners of, what we're doing and why we're doing it, and how to some extent. We're going to do all that in less than an hour, so hang on to your hats because we've got to get cracking. So we are stepping off a strong base. Boom. There we go. I won't do that all the time. We're stepping off a strong base, and if we can go to the next one. Look, this business has been now in operation for around about 20 years. We've got some very wise founders that set up a business that is revered globally. Our ownership model is genuinely unique. It is a source of competitive advantage. There is a high degree of sustainability to it, and that is a fantastic and a privileged position, frankly, that I believe we all come from. We've got a genuinely unique business. And over 20 years, we've achieved a lot. We've also just finished a 5-year business planning period. So the then board and leadership team back in 2010 set up a 5-year plan. That concluded June 2015. And the way I summarise that is that in the course of the last 5 years, in particular through that planning period, I believe the business is institutionalised, diversified and globalised. We've always been a fantastic business in terms of design. Over the last 5 years in particular, we've tried to put more strength into our operational capability, into our client management capability, certainly into our portfolio management capability, and into our business management capability. We've always been a well-intentioned business. We're now matching that with industrial strengthness, if you like, and so institutionalised, hopefully without bureaucratising. We've diversified and we've globalised. So just as an example, less than 5% of the revenue of IFM came from outside of Australia 5 years ago, and it was about 1/3 of the current level of revenue. So we've tripled the revenue, and we've also moved to it being less than 5% non-Australian to being now about 40 or so % outside of this country. We've established offices in, so the next one please, Vinna. We've established offices in Japan and Berlin to continue that globalisation. We've continued to improve the investment performance across the board. There's always things that we want to do better, always things that we reflect on and go, we should have done that better. But in the main, this is a strong performing investment management business across all of the asset classes and products, and 64 or something mandates and products that we run these days. And we've also strengthened the financial position of the business, and hopefully our capacity to retain, attract and develop world-class people here and in other parts of the world. We've a couple of other things that I just do want to point out. Kyle made the point at the recent IAC and AGM that we held for our Global Infrastructure Fund. In 2010, that Global Infrastructure Fund was $2 and a bit billion. Today, it's 12 point something billion dollars. There's been a $10 billion growth in our Global Infrastructure Fund. not just growth for growth's sake, but world-class, high-quality assets across many of the continents around the world, across a diversity of infrastructure sectors. We established the small caps team with Neil and Jim and Matt and the team, and we've already reached close on that. In other words, we've raised as much money as we want to raise before we got to a stage where we were too big and start moving markets around. That's a tremendous achievement. The track record there is also very strong over that 3-year period. We've established global index equities. We've done that for our clients. We haven't just done that for the sake of growth. Our clients have around about 25 to 30% of their Australian portfolios allocated to global index equities. And they continue to grow with their cash flow. They continue to get capacity constraint in Australian capital markets. We've got to continue to globalise our capabilities to support the growing global needs of our clients. If we're going to genuinely add to the returns of their underlying members, then we have to ensure that we do a great job in infrastructure, both debt and equity. But the bigger part of their portfolios is where we can make an even bigger difference. And if we are genuinely focused on the net returns of members of our client funds, we need to play a greater role in some of the other bigger asset classes where we can make that larger contribution just by the very nature of the allocation that they have to it. We now have 230, a little bit more than 230 staff in those 6 offices around the world. I think about 5 years ago we had about 80 staff. But we have not just grown, but we've continued to retain the cultural fabric of this organisation. It's something that we're proud of, it's something that differentiates us, and it's something that we will continue to do everything we can in our interview and our induction and our ongoing processes to ensure that with that growth, we are always mindful of the fact that this business is different. And part of that difference manifests in the culture of the place. So we've achieved a lot. We step off a good base. There's lots of other things that have been achieved, but in essence, we've institutionalised, diversified and globalised this business. We've gone from being an Australian business looking after Australian clients, investing in Australia, to being a business that now invests globally across a range of asset classes, 4 becoming 5, for a world-class client base that most other fund managers in the world would kill to have, and we've got them. So off that base, we've done a lot to think about what the opportunities and issues and the like are for the next few years. So there's lots of inputs that have come from our board, from our leadership team, of course from yourselves, from our clients, from a range of networks, if you like, that we have globally, both business advisors as well as economic and market advisors. And we've tried to distill it down to, what are the themes and therefore what are the plans. So the things that will define our environment in the next few years, lots of issues, opportunities, risks, etc. But in essence, we believe there will be continuation of low return environment. Thank you for Captain Obvious, perhaps. But that is quite profound and fundamental in what it does in terms of our planning. Our clients will be continuing to search for yield in that lower interest rate environment. They are increasingly weighting to unlisted asset classes. The biggest intention of all pension funds globally is to increase their weighting to unlisted assets and in particular infrastructure, according to the Global Pension Fund Index. So we are in the right spot to really help clients given their intentions over the next few years. Having said that, they've got big allocations still to listed equities and debt, and we've got to play, as I said, an even greater role in those asset classes as well as. There's some big brand names out there, and they're not necessarily delivering, and they will come under intense competitive pressure. In a low interest rate environment, you've got to get your fees down and your returns up, most particularly in this country. Lesser pressure on that around the globe. But in a low interest rate environment where your absolute returns are coming in, of course clients are going to have a closer look at where they're getting returns from and who are the agents and how much are those agents taking out of the system. IFM has a wonderful capacity to really compete in this environment compared to some of the other guys and competitors that have got big brand names, but frankly the substance doesn't stack up. And so let's go after them because it is the client's money, not those people's money, and if we can do a better job of it, then we should be managing it, not the big brand name. Vinna, please, the next. The board feedback. Look, I think it'd be fair to say that a lot of people, perhaps internally and perhaps externally, think that our board has been focused on growth for growth's sake. I think that's a little unfair, but I can understand where it's come from. We've grown and we've grown rapidly. But we've also said no to clients, we've said no to assets, of course, we've said no to staff. So our growth has been considered, and it's always been because it's in our investors' interest to grow. And if the answer is it's not in their interest, then we won't take that growth on. Having said that, the board is still up for growth. We've got to nonetheless balance the consolidation issue, if you like, doing a better job of managing our team of people, doing a better job of managing our staff, our clients, our P&L, our portfolios, and growing, so long as it's in our clients' interests. We do want to ensure that we have a sustainable cost structure. That is not about, we have changed and improved our remuneration policies and systems. We are competing with the best and biggest and ugliest in the world. We do need to make sure that we can retain and remunerate talent. Having said that more broadly, we have a business model that is very focused on great value for money for our clients. So how do we maintain a sustainable cost structure? We want to continue to innovate, and we've got lots of great ideas in this business, and we want to continue to operationalise those and bring them to the benefit of our clients. We also got 35 of our extended leadership team across the globe together in March out at Yarra Valley, and that was a big group, but it was still a forum in which everybody had the opportunity and indeed took the opportunity to make a great contribution to what they thought we needed to do as we went into the next planning period. So we got a broader input from the leadership group, we got better input from the board, and our leadership team, I suppose, focused on a number of similar issues, but the thing that I do want to point out here is, again, it'd be fair to say that a number of the years, many of us have looked back at the scorecard and gone, gee whiz, I thought we had a better year than that in terms of the corporate scorecard. And part of that has been a whole range of factors, but part of it has been how we've set those targets. And you'll see that we've taken a lot of the learnings, and the targets that we're setting this year reflect some of the insights that we've all had to learn from, and frankly, in some instances, bear, even though we might have gotten to the end of the year and thought, gee whiz, it felt like a bigger year than that. So you'll see that in the targets that we've agreed this year amongst ourselves and indeed with the board and for all of us. And we also had an IAB meeting, which was really valuable. So we had our 5 largest shareholder investors, the trustee, a trustee, and the CIO, Chief Investment Officer, from each of those big 5. Join us on the 5th of May, and they shared with us their views on the things that were worrying them and driving their strategic planning, their strategic plans, and what they wanted IFM to focus on as we finalised and formalised our strategic plan. And it was a very valuable session, most particularly for them. They fed it back in the ISQ recently. They thought it was a very, very worthwhile session, and it was quite a milestone in the relationship between our big 5. What they in essence said is they are all at different stages. You've got Vision, who are relatively small and liked pooled investing. You've got Host Plus, Hester and Cbus that are getting bigger and want to have greater input and transparency and involvement in the decision-making process. They are committed to the collective, but they want IFM to evolve to recognise their evolution. And then you've got Aussie Super saying, look, we're big. We can do a lot of this ourselves, but we want to do it with this group of people and with you, IFM, but you're going to have to evolve more rapidly, frankly, than you have in the past. We like what you do, we like how well you do it, but evolution in particular of your infrastructure product is going to be important to us. And so how is it you continue to prioritise the pool and at the same time evolve other product structures to have complementary capital rather than competing capital with the likes of Aussie Super? Now that microcosm of those 5 that were sitting in that room is in essence our global prospective client base. Smaller guys, mid-sized guys and big guys. And how is it that IFM really serves them well across the totality of the asset classes? But again, a lot of the relationship with that IAB and a lot of the relationship with our clients around the world is defined by infrastructure equity. And if we can get that evolution right and step off the fantastic strength that we've got with 55 world-class investment professionals, the track record that we've got, etc., and evolve our product model with the pool front, centre and prioritised, but with other capabilities sitting around it, we have got an enormous opportunity to not only be the leader in infrastructure, but to have a deeper and broader relationship across all of the other asset classes. And that's what they said to us. If you can get that right, then we'll give you more money across the rest of the asset classes, let alone more money in the infrastructure asset class. So our plan on a page remains unchanged at the top end. Our 2020 aspiration remains to be the world's most trusted institutional funds manager, consistently meeting and exceeding our objectives, and a brilliant place to work on behalf of a truly global collective. First point, institutional funds manager. We don't want to be retail, we don't want to be mezzanine. We're not after that. We want to have the capacity to really invest for the long term by only having institutional long-term like-minded clients. And we want to be a fund manager. We don't want to be an investment bank. We don't want to be a financial planner. We don't want to be an insurance company. We want to be a funds manager. So as we evolve our product model, we won't drift into the advisory space and compete with the investment banks. It's not what we want to be. We've put a little bit more flesh around what does the world's most trusted institutional funds manager really mean. You'll get all of this by way of both hard and soft copy to have a closer look at how we've fleshed it out. In the interest of time, I'll keep moving on. In essence, we have come up with, after all of the input from a broader range of the leadership team, a broader range of the business, better input from the board, strong and clear input from our clients, we've landed on 4 themes, 5 goals, and 8 initiatives. 4, 5, 8. Is that right? Sounds like the model of a European car. Anyway, let's not go off into the car issue. So 4, 5, 8. 4 themes, 5 goals, 8 initiatives. So let me just walk through what we've resolved them to be. In terms of the 4 strategic themes, 2 of them balanced on consolidation, doing a better job of what we've got with what we've got, and 2 of them focused on growth. Consolidation and growth, not consolidation or growth. Growth will support consolidation and consolidation will support growth. We need to be able to walk and chew gum. So, respect and retain our heritage. It is different. It is globally unique. Let's ensure that we keep it culturally, operationally, strategically, financially, in everything that we do. Prioritise the investors, truly and really. Not like other people that talk it, but don't walk it. Strengthen our resilience, do a better job of retaining our people through cultural, remuneration and other capabilities. Do a better job of focusing on extracting better value from the $57 billion that we currently have under management. Do a better job of managing our P&L so as we have the strategic and financial flexibility to make the investments in the innovations that will support our clients' returns. So strengthen the resilience of our people, our P&L, our clients, client management, and of course our people management. We nonetheless still want to selectively diversify. We want to go into other product ranges, other asset classes, witness international listed equities, because we want to play a greater role in contributing to the net returns of our investor clients. And we want to globalise the business. We want to globalise our capacity to invest in different parts of the world, in many asset classes, and we want to globalise our capacity to raise capital from around the world. Because capital, so long as it's institutional and it's long-term and like-minded, gives us scale benefits. And with scale benefits, we can drive the returns of our investors up through lower fees and better access to better quality, higher performing securities, assets around the globe. So there are our 4 themes. Can I just... one of the priorities in that is, first and foremost, as our clients have said, is to get to that genuine leadership position in infrastructure, equity. So much of the relationship is defined by infrastructure. We've got many aspects of our business and our portfolios, etc., that are leading, but there is an opportunity to be the leader across the entirety of infrastructure equity, and with that, we'll have the capacity not only to deliver great results to our clients through infrastructure equity, but liberate us to even further add across other asset classes. And so with that, we want to extend our unlisted capability. We do believe in the illiquidity premium that's not just afforded through infrastructure equity, but also infrastructure debt and also private capital. It has been, with great respect to all of us that have been in that business for a while, it has been moribund. And we are now revitalising that private capital under the leadership of Steve. Clients are liking it, the returns are coming up, it's adding to the P&L of the business, so it is game on for that, and we want to extend our unlisted capability not just in infrastructure equity but also debt and private capital. We want to diversify our geographic mix in terms of where we raise capital from, and we want to diversify our product mix in terms of where we invest that capital over time, and we want to diversify our institutional client mix. We've got some great conversations underworld with people that will be clients, hopefully, of IFM the next 2 to 3 years out. But it'll take years for, the likes of the biggest sovereign wealth fund in the world to become a client of IFM. But they will be. They just don't know it yet. But we are talking to groups like that as we continue to diversify our institutional client mix. Our 5 targets, let me just spend some time on this. So we've done a lot of work with the team, a lot of work with providers like the ISQ people, with Val and Eddie and co, with MySay, with Christina and Sahar and co, with the business development team on the FUM targets to do a lot more analysis, get a lot more input, and learn from some of the learnings of prior scorecards and goals that have been set. So put a lot of work into the thresholds, because as you all know, below threshold, it's a duck. And so we need to make sure that that's appropriately set. And in essence, I think in a lot of areas we've moved those things a little bit to the left is probably the way to summarise that, to give us a greater likelihood that we achieve at least a threshold outcome. Then we've put a lot of effort into the MET and indeed the stretch through that more robust analysis, scenario testing, engagement with the team, and then ultimately landing on these numbers. So you'll see all these, they'll all come around to you in great detail, but a couple of comments to make. Firstly, STI for all of us, 75% is your KRAs, your own individual results. 25% remains the balance scorecard of the firm, this, and the cultural foundations. So 15 balance scorecard and 10 cultural foundations. So that's unchanged. That's how its STI's all worked, and we've all got STI. So these are important in that context. The LTI, for those that are on long-term incentive, has now switched from being 75% firm-wide goals to being 40% firm-wide goals, and 60% your KRAs. We think the business has matured sufficiently to still have the alignment through that 40%, but 60% of the LTI for those that are eligible will be your own KRAs. So that's a shift from the current 75 firm and 25 corporate to 40 corporate and 60 personal. That's, I think, an appropriate shift. Came from the feedback from our Project Best. I think there's 26 people that sort of were on a little group that fed that back to us, and so we've adopted that. The next thing that I want to say is that this is 55%, this is 15, and these 3 are 10. So that's how the scorecard is constructed, 55, 15, 10, 10, 10. In the financial, we no longer have an infrastructure equity deployment objective as part of that. So we're not under the pump financially, and therefore not creating some of the potential conflicts that come with that. That's a really good outcome strategically, and frankly it's a really good outcome in terms of the likelihood of us being able to meet that. Philip assures me that he's got a bottom drawer full of little tricks, and we'll be, as always, and we might see some of them this year and get closer to that. And so, there's, all jokes aside, we are conscious of the fact that we need to balance, an element of, let's go after these things, but an element of motivation and gettability. Is that a word? I think I've said before I was in E for English at school, and the F guys were really dumb at English. So that's our scorecard. It's been a lot more thought out, a lot greater input, a lot more scenario testing and engagement with providers like MySay and ISQ, and highly gettable, because I genuinely want to sit in this room this time next year and have people looking back on the year that was and saying, that was a great year. I had a great year, we had a great year, and as a result, our scorecard is strong and all the things that flow from that. In terms of the 8 initiatives, I'm going to ask a number of the leadership team to walk through these in a little bit more detail, but the 8 initiatives are around there: asset management, doing a better job of extracting value in a low interest rate environment from the 26 investee companies that we have across those 2 infrastructure equity portfolios. I'm looking at you for an acknowledgement that yes, it's 26, or no, it's, or you don't know. Global Head of Infrastructure.
That's 8 cards. You can't imagine 1 or 2, but 26 close.
Oh, okay. There we go. I was told, so doing a better job of extracting value for our clients from a heightened focus on asset management. We do it well, let's do it brilliantly. Project Summer, getting to a leadership position in infrastructure equity. Expand the listed equities capability. I'll have Neil expand on that, but again, our clients' biggest exposure in Australia is Australian listed equities. We do a fantastic job in passive, a 19-year track record of boringly beautiful. Just read the ads, speak to Aidan. Boring and beautiful. Wrong on both counts. He gets to speak after me, so I know he'll return the serve. Project Best, really, listening to what you have to say, thinking about what best looks like in terms of attracting, retaining, remunerating, and developing, a world-class team of people, which we now have. Accelerate private capital. It is a source of illiquidity premium. We have a long and strong track record. We've now reinvigorated that business, the model of it, the investment partnership that we've set up around it, the returns in it, the contribution to the P&L, the motivation and the morale of the team. We've got a real opportunity in private capital to elevate the contribution to clients' portfolios and elevate the contribution from this business's perspective. We want to continue to evolve our capacity in infrastructure debt, and Robin will talk through that. We want to leverage our position that we've established in Japan. Shota-san and the team and Eddie have done a great job up there in establishing us, in getting clients on board, but it's a big market and we have an enormous opportunity to leverage our position in Japan and potentially open an office in Korea and or somewhere else in Asia in the near term. And in an environment where clients want to get fees down and returns up and have a big exposure to international listed equities, then we can and should play a greater role there through the better beta solutions that Aidan will walk through in a minute. So, a fantastic process, much more engagement, much more input, a very clear plan, continuation of the strengths that we otherwise think are working, and then modifications in areas where we've taken that feedback and done a lot more analysis. And as a result, as you can probably tell, I'm pretty enthusiastic about the likelihood of us getting it, and I look forward to it. But with that, I will now hand over to, I think, Kyle in the first instance. Is that right? No? Thank you very much. To Josh to talk about... What's Josh talking about? Josh is talking about Project Summer. So Project Summer is our aspiration to get to a genuine position of leadership in infrastructure. So I'm going to have Josh and the various members of the leadership team walk through some of the initiatives in a little bit more detail.
5 minutes? 5 minutes? Okay. I've got one slide. That's it. So Project Summer. Project Summer was a review of our infrastructure capability. Most of you will know that. Started in November last year. I led the project together with NMG, our consultants. We conducted 25 plus interviews internally, externally, and came up with a number of recommendations. So we'll start with investment governance. I can still remember the report that came through in March. Ashwin Field was leading the review together with Dave, with Mike Oliver. They said, look, one of the recommendations we want to put to you is a restructure of the investment committee. Before we show you the report, we want to talk you through what the restructure actually means. We think that all C-level executives should step off the investment committee. I thought, oh yeah, okay, yeah, Brett, I can understand that. It took me 5 seconds to dawn on myself that it included me. I said, look, I engage you guys. Me? I said, yeah, well, you. So look, what that really means, what I want to convey to you, it was an independent review from NMG. We took into account feedback from clients, feedback from internal staff, and we decided that the IC should be restructured. Robin stepping in as the chair, Brett stepping off when we take on a new independent member of the IC. We will appoint a chief economist. He or she will step on the IC as well. And we have also appointed Steve Lipkin to the IC. Quickly through asset management, Carl will touch on asset management. Origination, we've done a fantastic job. There are a couple of tactical recommendations on origination, more about information sharing and things of that sort. Valuation, monitoring, and reporting. Quite a bit of feedback from our clients around their perception of a lack of transparency. Look, we believe that we've been doing a fantastic job in reporting. We give them everything that we have and sometimes more. There's a perception that there's more to be given. So we'll give them what we don't have. Commercial flexibility, Brett touched on that, co-investments. Aussie wants a different arrangement, investment partnership, all that. That's part and parcel of Summer as well. Roles, accountabilities, and incentives, a restructuring of some of the KRAs, linkages to fund performance, linkages to client feedback, and foundation shareholder alignment. So the only thing I would say there is we are appointing a North American director to our board. That will be a positive step for us in recognition of where we've gone over the last few years. And it provides a fresh perspective to the board as well. I think I do have another slide, don't I? Yeah, okay. Well, we have a steering committee. We've met 4 times now. We meet every fortnight. We will implement all the recommendations in Project Summer by the end of FY16.
Thank you, Josh. I'm going to talk to you about Project Alpaca. Alpaca is Australian large cap active equities, and the reason we're looking at this is because Australian equities is our client's single largest asset allocation, and global equities typically is a close second. In this market, we have 2 products currently. We have Aidan and his team's passive product, which is probably accounts for around 20% of Australian equities, and they do a fantastic job delivering market returns, delivering beta at very, very low cost. And then we have the small cap team up in Sydney, which is probably about 5% of this part of clients' portfolios. And the small cap guys up in Sydney, Matt and Jim, sometimes I help out a little bit, have done a fantastic job delivering alpha of about 10% per annum since inception. So that's 2 very, very strong capabilities we have, but there's 75% of this portion of clients' portfolios we're not addressing. So can we replicate the success we've had elsewhere in Australian equities in the large cap active space? There is an issue about passive versus active. It's a long debate. It's been going on for a long time, largely because in the US, the mutual fund managers have been spectacularly unsuccessful at beating the index. In the Australian context, though, if you look at this chart here, the red line is the median manager in the large cap space, and they've delivered 1.6% ahead of the benchmark. Now that is pre-fees, so you can probably knock off 40 bips, but it still gets you more than 1% ahead of the index. And the best managers have beaten the index by about 3%. So we do think there's alpha to be had in large cap active. If you're a large client, though, like Aussie Super, and you've got a whole bunch of different managers, you don't just get the good guys, you get some of the rubbish guys, and by the time you blend it, there's an argument you might end up just getting the index anyway, so therefore why pay the fees? Well, this table down the bottom right-hand right-hand corner shows you the returns to industry funds and just their Australian equities portfolio. And over the last decade, the industry funds have beaten their equity asset allocation has beaten the index by 0.3% per annum, and that is meaningful. Now, you've got to remember that a portion of that is the passive component, which drags down the returns. So if you strip that out, the active guys are probably adding 40 or 50 basis points per annum. So I do think there is alpha to be had in the large cap active space. So what we're doing is we've got a bit of work to do to flesh out the plan. We think that the way to go is a style neutral portfolio that can generate alpha in a consistent manner. But there's a bunch of issues to address. So what sort of size team should we have? What should the structure be? What is the best investment process? And what is it clients want? So all of that stuff is work in progress. We'll be coming back to the leadership team and the board with a much more detailed proposal, but we do hope to have something in place by the end of the financial year.
Taking Josh's lead, I have a single slide presentation, so hopefully it won't take too much time, and also sort of, I guess, following on the automotive theme that Brett alluded to. Our initiative is about accelerating the private capital platform. I think we're more in a people mover than a high-performance sports car, but definitely maybe a turbo diesel people mover. So, sorry, wasn't holding the mic close enough. Our initiative it's sort of a business as usual initiative, but really what we've tried to do is highlight three sort of key areas of our model. And as Brett as well spoke a little bit about, we have engaged with clients over the last 12 months or so and developed what we think is a relevant and interesting and effective investment partner model to help our clients meet their needs and certainly develop superior investment returns to the underlying members. So the first of the three limbs is about scaling and enhancing our origination capability. And by origination, we really mean outbound and inbound. Outbound is the more difficult part, and that's about developing what we think is a differentiated competitive position in the Australian market where we can, in interesting and innovative ways, identify proprietary or less competitive opportunities to invest significant amounts of capital in individual, fast-growing or transformative Australian and New Zealand companies. And what that really means is that we will try, and I think have already quite effectively leveraged off our history in the fund of funds business that we've built up effectively over the last 25 years in private capital, private equity, to bring world's best practice in terms of investment methodologies, industry themes, sectors that are interesting, things that we know about by staying close to and communicating with whom we think are the best 2 or 3 dozen specialist private equity fund managers in the world. We like to bring what we've learnt from those relationships and that experience to Australia in order to identify and add value to investment opportunities that we uncover here. And in nuts and bolts terms, that means that we have to roll our sleeves up, do some research around our key target investment sectors, map industries in a very careful and deliberate fashion, and be very creative and proactive about identifying investment opportunities. The other side of the coin is inbound, and that's intuitively the easier part, and by that we mean really picking up the phone when people call us looking for capital. In order to make that part of the equation move faster, we really have to improve our networking capabilities. We have to market ourselves. We've had some good press over the last couple of weeks, and we have to hope and try and sort of educate the market in the sense that when people are thinking about their capital needs, they pick up the phone to private capital at IFM. Part of that is establishing what we call an entrepreneur and executive network, and what that means is working closely with and identifying a small group of people who have specific expertise or domain expertise, as we like to think about it, in the target sectors that we are interested in, and aligning ourselves with those individuals to help identify, evaluate, and manage opportunities and companies that we invest into. The second limb of our initiative is really about helping us get to the table, so to speak. So in the way that our mandates are structured, and our HESTA mandate is our first sort of fresh pool of capital, we sometimes need to get across some threshold issues, do some due diligence before we can go to our clients and say, will you fund mainstream due diligence for this opportunity? In order to do that, we need access to some capital to go out and do some preliminary work. And we really think about that as a sort of a small underwriting pool, which hopefully won't all be expensed, Philip. Hopefully we'll be able to recoup most of the capital that we utilize in what we think about as early exploratory due diligence or proof of concept due diligence, and hopefully we'll be able to get that reimbursed from our clients once we have a due diligence budget approved for an investment and we're into the formal due diligence phase. The third, and I suppose most obvious part of our initiative, is building the team. In order to go faster, we need to be able to do more, and by doing more, I mean we need to be able to execute more than one potential opportunity in parallel. The way we're set up now is we have a great team, we have a great set of resources, good skill set, but the reality is that if we get engaged in a single transaction, we pretty much sap up all the resources of our team trying to do that. So what we need to do is build the team, augment the skill set we have, and we'll specifically be looking to bring on board skills that can help us with our outbound pipeline initiatives and with our deal execution capability. So that means individuals with potentially investment banking backgrounds, strategy consulting backgrounds, and certainly good private equity skills and proven investing track records. So yeah, that pretty much sums it up.
Good morning. Imagine for a moment we're in a different place and a different time. You're lying on the grass, looking up in the sky. You can see the northern lights. We're in Finland, and the year is 2001. And Stella Wang, we've invested in the local market via a very beautifully boring index fund. We naturally assume when we go into an index fund, we're going to have a well-diversified portfolio. It's across the whole market. Why wouldn't we? Well, in 2001, in Finland, 70% of our money is in one stock, Nokia. Give me a show of hands if you've ever owned a Nokia telephone. Japan, Sydney, I want to see your hands. So leave your hands up. Leave your hands up. And put your hand down if your current mobile phone is not a Nokia. Sorry. You all got it, you're right. So no one owns a Nokia now. How do you reckon that straw poll would reflect in the share price? Without diversification in time, the risk of underperformance is high, and you'll certainly have a lot more volatility. Australia's not that different. The ASX 200 may as well be the ASX 5. I don't know what the other 195 stocks are doing. Maybe we thought it was manly in Australia to have 200 stocks. I don't know. Because, France has 30, Spain 35. Neil's fallen off his perch at the talk of the last 100 stocks. %38% of the market is in 5 stocks. It's not well diversified. Next slide. Better Beta is an alternative weighting scheme. It's systematic and rules-based. It can be as simple as an equal weighted portfolio. It can be as complex as low volatility or minimum variance. So in Finland in 2001, maybe an alternative weighting scheme would have been better. By equal weighting the ASX 100, as I've done here, we achieve a significantly less concentrated portfolio. And you can see the light green there is the Better Beta portfolio. It's equal weighted. And from a sector perspective, it's more diversified. So arguably in Australia, this is a better way to achieve the market beta. Hence the term Better Beta. So what are we currently doing? Our team is in the process of developing a Better Beta Australian small cap portfolio. We're also, as part of the global project, developing a Better Beta portfolio for global equities, in which we're developing intellectual property ourselves. The small cap one is based on a RAFI methodology. So, as part of the strategic initiative, what are we going to do? We're going to explore further how we can leverage our existing skills and capability. So it could be in the area of Australian large caps. It could be other systematic equity strategies. We've already got a pipeline of ideas that we'll look forward to exploring in the future. So who's going to do it? Lawrence, Adam and Megan. They've already started and they'll be the ones that drive this going forward. Thank you.
Next year I don't want to follow Aidan. I'm going to talk about the asset management initiative, a bit about asset management generally, but particularly about the asset management initiative. And this is really an initiative that's being led by Danny Elia, who is the head of the asset management team. He usually does this presentation in an hour, and I've tried to distill it down to 5 minutes. First of all, asset management is very much core to what we do. It's core to delivering returns across the portfolio. And I believe our team has some of the best asset managers in the business, including some of the people in this room. In the past, we've put CFOs into businesses. We built management teams from scratch, and we've delivered key initiatives as part of broader acquisition strategies. And right now, we're managing the single largest investment that we have ever acquired, which is the $5.7 billion Indiana Toll Road. And the ability to manage that asset was a key reason and a key competitive edge that we had over the Canadian funds, who've got no ability to manage that asset and had to bring in an operator at quite a substantial cost. So asset management is something we do well, but it's certainly something that we can do better. And in particular, it's something that we can do more consistently. And that's the basis of the asset management initiative. It's about developing the capability that we need to deliver consistent and methodical outcomes across the portfolio. And the capability comes from systems, training, and dedicated asset management executives. So that's really the key change from what we have been doing to date and what we're going to do going forward. And the result of the initiative is, as Brett mentioned, is we are positioned to take leadership in this part of the business. I think we have a terrific acquisition capability. We have a terrific portfolio management capability. This is the one area where we can really step up in a part of the market where there is no leadership. Now, some would say GIP is the market leader. I think they've got a very good marketing story, but I don't think they're particularly good at doing this either. So there's a real hole in the market and an opportunity for IFM. So if you look at this slide, and I've got one slide, the left-hand side of the slide, it really talks about what asset management is in practice. And it breaks down into three key categories: protecting the assets, enhancing their value, and exceeding what is otherwise possible because of the scale of the portfolio. Protecting the assets is about managing risk. It's about knowing what can go wrong, ensuring that it doesn't go wrong, and if it does, making sure that the assets get back on track as quickly as possible. And so the initiative will provide a range of assurances and systems that will allow us to bring best practice risk management practices and frameworks into the portfolio consistently across the board. So it'll include factors like delegations, contracting strategy, disaster recovery, and cybersecurity. So protecting the assets is the single most important aspect of the asset management strategy and the asset management framework. The second objective is around enhancing the assets, and that relates to our role, IFM's role in ensuring the assets deliver their full potential. Put simply, we do this by pressuring management to either increase revenue or decrease costs. And if we want to pressure effectively, then we need to know what's possible for each one of our assets. That requires benchmarking, analysis, and appropriate levels of training for the investment team. By knowing what's possible, we can ensure that we're setting targets that stretch the management team and stretch the assets. When the management teams deliver, we'll have compensation overlays that properly reward them for that delivery, and when they don't, we'll be in a position to act quickly and change out those management teams as necessary. The third objective relates to exceeding, and that's really the benefits of the scale that this portfolio can deliver. To put that into context, the buying power of the two portfolios is greater than BHP. It's greater than Rio Tinto. We have a tremendous amount of buying power across this portfolio. IFM is the single largest credit exposure for CBA globally. That's an extraordinary amount of scale, and we can use that scale to deliver scale benefits to the assets specifically. Danny cites the example of insurance, where based on buying as a block, we estimate we can save about 25% in the aggregate costs. So by being part of this very large portfolio, we can exceed the performance of what the assets could otherwise deliver on a standalone basis. So those are the three key objectives, and if we deliver those, we will clearly establish ourselves as a leader in this space. And I think from a strategic perspective, there's an imperative to do that. Things are expensive. It's very hard to find value in this market. So we have got to drive every dollar from the assets that we've got, and we've also got to demonstrate to our clients that we're earning the fees that they're paying us. Thanks.
Good morning, everybody. I'm not going to speak to all the slides I've got. If I can have number one, Vinna, thanks. I've got less slides than Aidan, but more words. This is really only there for context. Some of you in this room, particularly here in Australia, have got less familiarity with infrastructure debt than our people in New York and London, who we've been speaking to last night and this morning as well with this same presentation. If you've got any questions about understanding this value proposition, please come and talk to us. I reflect on the times when this firm was 50 and 70 people. It was easy for people like me to, even people with bad memories like me, to remember everybody. It's getting beyond our reach now. If we appear to be standoffish, it's often not. It's often because we're shy and we're embarrassed if we don't remember every single person's name. So don't feel ashamed of coming to us and saying, I'm confused, please explain. That's what we're here to do, if we can move on. A lot of you won't be familiar with this history either, so this recaps it. The essential message here is we've really only been doing infrastructure debt outside of Australia for 2.5 years. The first move there was when we were able to recruit David Cooper to lead the London team in late December 2012. So we've really been doing this for 2.5 years. New York was more or less a year later, so 1.5 years in New York. Excellent, thanks, Vera. So why are we talking about funds? The operational word here being funds plural and not a fund singular. And it's because we started our global infrastructure debt business, i.e. outside Australia, essentially through individually managed accounts, IMAs or mandates, and not through funds. That's in contrast to Australia, where we always invested in infrastructure debt for 16 years, since 1999, but through a sectoral allocation within the diversified credit fund known as the specialised credit fund. We only added IMAs in Australia later on. So it's a different approach overseas. But today, infrastructure debt, funds under management, to give you an idea, is Australian dollars 3.7 billion in investor commitments. About 2.6 of that has been deployed, and we've got about 1.1 billion of dry powder sitting up our sleeve. We can't just spend that as we wish. We have to spend that within the limitations of IMAs and mandate constraints. 1.5 years ago, we had a funded strategic initiative to create a global infrastructure debt fund, singular fund. But we found a one fund fits all, one size fits all approach would be very costly to set up, mostly on legal costs, impossible to optimize the differing mix of investor appetite, asset supply, and very difficult to accommodate all the different regulatory requirements of different regimes around the world. And on top of that, we had no track record to speak of to sell ourselves outside of Australia. And we also had no team in America, only intentions to build a team. So we, instead of using that money to go down that path of building a fund, we used the money to recruit more people and do deals to get that track record and establish that presence. And so now, outside Australia, we've got 9 staff doing infrastructure debt, 5 in London, 4 in New York, and together as a team, we've been together 1.5 years, and we have established how to work together in one global process, one global culture. It's working. And we've invested over $1 billion into infrastructure debt deals through those global mandates. The next slide, thanks, Vinna. But it's hard to sell the concept of an IMA. It's doable, we've done it in the past. Clearly, when we've got good client engagement, it can be done. But you're really selling a capability, not a hard-edged product. It's difficult to get engagement with new clients with whom you don't have an existing relationship, without a product to sell. And on top of that, our mandate limit, our floor for mandates is around about $100 million. Below that, it's just impossibly scale inefficient for us, and we can't deliver low fees and value. in that format. But that $100 million is just too large for the huge number of small pension funds out there. Now, this is something that's a bit different between Australia and overseas. Our shareholder investors, or certainly the big ones, are big clients, and $100 million is not a huge allocation for them. Overseas, many of the people we're engaging with, $100 million is a big chunk. And so we need to have a different product. We began to reconsider then whether a fund, or more likely a series of funds, regional funds, will be appropriate. Next slide, thanks for that. So the first cab off the rank is going to be a US dollar fund. We think this is the most financially viable area for ourselves. It's going to be for US dollar investors, and it doesn't matter whether they're US domiciled or not, but they've got to be familiar with the idea of managing and accessing US dollar exposures. So in other words, it will work for some people, we hope, outside of America, and particularly thinking of Japan and Korea in that sense, hopefully. It will be primarily US dollar assets, and it will be primarily energy sector infrastructure. And it will be in high yielding debt. So in credit rating terms, that's sub-investment grade, double B, single B. So, and that's because that's where we see both the asset supply and our ability to manufacture investor demand. But we have to carve out that new concept for investors, because we're trying to sell to them the idea that you can have higher yields but still with low risk. And that's not something they're familiar with. We get the lower risk by senior subordinated infrastructure debt deals, but they're used to seeing higher risk in higher yielding debt. So we have to carve out a bit of a new space, which is unusual. And that won't be easy to differentiate ourselves from other forms of high yield debt, but we do think it's doable, and we do think it's going to require effort, but we do think we also have an advantage and an early mover in that respect. We're going to continue looking at creating either or, both of a UK pound sterling based fund and or a euro based fund. But over in Europe, the viability of that at this point is less clear, and we're going to continue investigating it. And the reason for that is because whereas here in Australia we've often straddled the investment grade boundary, we've extracted an illiquidity premium just above and just below. That's harder to do in those markets where investment grade is a bright line in asset allocation terms. You've either got to be fully over it or fully under it. And also in Europe, the competition from both banking and from life insurance companies is a bit more extreme, and some of that illiquidity premium has been traded away in the markets. And then we're also going to look at a Japanese Korean type product. As I said before, we hope that some of those clients will be interested in a US dollar product. The real challenge there is getting the right mix of assets for them. Again, they'll have this bright light investment grade, sub-investment grade issue, and they'll also have difficulty with, we will have difficulty with accommodating the ability to currency hedge those assets. All of this, by the way, is not the only benefit we get out of this. Actually getting clients to give us money through funds is one thing, but of course in that engagement we do expect to pick up a lot of collateral business in the form of additional IMAs or mandates. So that's all from me for the moment. If there's any follow-up questions, very happy to take those at any other time. Just come and walk into my office. Thank you.
Okay, thank you all. We've got only a few minutes for questions, so let's jump to those. Beyond the initiatives and a deeper insight into some of the initiatives, hopefully you've also seen a deeper insight into the leadership team. Smart group of people, very experienced group of people, very decent group of people, all culturally aligned. We've got a fantastic leadership team and a fantastic group of people through the business, so thanks to all of the people that just stepped up and gave us a glimpse, not just into the initiatives, but into themselves. Yeah, always a competition, isn't it, Aidan? He surprised that one on us all. Okay, questions, please. Fire away to any of us.
You need to speak into a microphone if you want to ask a question so the guys online can hear you. Just put up your hand.
Gerard Fullerton, for those that are sitting outside of Melbourne.
Thank you very much. Just to break the silence, it's a question for Steve, actually. Given the globalisation initiative across the board for all of our products, is there an opportunity, oh, he's over the back here, isn't he? Is there an opportunity to globalise the private capital product as well? Is that, or are we focusing on Australia in the foreseeable future?
Thanks, Gerard. Certainly, in the short to medium term, the focus will be Australia and New Zealand, but we absolutely believe that this model will be applicable and relevant to our clients, both our Australian clients and hopefully one day our non-Australian clients in offshore markets. So yes, our plans are to ultimately globalize our product as well.
Thanks, Gerard. Thanks, Steve. Other questions? Come on, don't be shy. Got a couple of minutes.
Any from overseas? No?
Duncan.
Good work. Hi, maybe for Neil, just given the Aussie equity large cap ambition, some would say that that's probably the most competitive market that there is. I mean, there's 300 plus Aussie equity managers out there, and we're trying to compete against them with nothing to start from. Well, so I'm just interested how you plan to do. I mean, you're buying whole teams or targeting specific individuals, or how we plan to build out that capability.
Yeah, I think that's a very excellent question. Thanks for that. There's no doubt there is a lot of managers out there, but I think Brett Chatfield from Cbus, for example, recently said that to get good quality capacity, so a decent chunk of capacity from a good quality manager, is actually very difficult in this market. So although it looks a very well supplied market, I would argue that actually funds with a decent chunk of capacity and a real good process at the right kind of fee structure as well, that combination is actually much more rare than you would anticipate. So I think there is a role for IFM with our unique business model to participate in that sector.
More questions, please? Mike?
Yeah, Mike.
Thank goodness everybody put their hand up so far I know the names of.
Yeah, it seems to be a continuing theme. I think I said at drinks last week, the longer you spend at IFM, the less people you know. So it's you'd expect that from an Irish person. So yeah, comment. Question, Brett, just in terms of this, obviously I've been part of this as a member of the leadership team in developing it, but perhaps you can give a perspective on the extent to which this has been relayed to our key investors, particularly through the IIB, and what sort of reaction has there been to our business plan and our strategy going forward.
Thanks, Mike. I think IFM has done a number of things really well. One of the things that we can do better is more effectively engage with our clients, and that's come through from ISQs. It came through last year. They wanted us to talk to them more openly, more candidly, more regularly, and also listen to them more effectively and fully. And so we've acknowledged that, and we're trying desperately to do a better job of that. And part of that is around both their input into the business planning process, witness that special IAB meeting, which was incredibly valuable for us, and most importantly, our clients have fed back that they thought it was incredibly valuable for them, and it's not something that we had done as formally and as well in years gone by. So the input has been, I think, improved and increased, and what we are now doing is we're playing back to them, the why and the what, and we're spending a lot of time on the why. So why grow? Because there's been a little bit of tension around, you've grown really fast, IFM, and we're less important to you now. They don't directly say that, but that's clearly part of their message. And so we've done a lot more on the why and not just the what, and that includes playing back to them at the IAB. We've given them a 25-page document, which is an abridged version of our business plan. And the only thing we've taken out is some of the really detailed financial stuff, but they've got the headline P&L and the expenses and all that sort of stuff, not the salary details. But we've been a lot more open with them. And Gary and I are also at the moment going around and seeing all the chairs and all of the CEOs having meetings with all of the major chairs and CEOs to explain to them, this is the input we heard from you, this is the input we got from the leadership team, this is what we think is going on around the world. And as a result of that, this is what we want to do and how we're going to do it, and most particularly how we believe it's going to benefit you. And closing that loop. So we're trying to do a much better job of engaging on the way through and communicating, much more effectively. And I think our clients are embracing that. We're certainly hearing that from the ISQ feedback. However, the world is a very competitive place, and we've got to continue to lift our game there off a fairly strong base. Other questions? Janice. See, 4 from 4.
Thanks. I think it's a really exciting initiatives that we've got up there. My question's probably around what's not there and your thoughts or the leadership team thoughts. I guess the first question is, we've heard a lot from the investment teams, which is really good, but I guess a big part of our business is also the support teams. Is our view that our support teams are keeping pace with our investment growth, and is there a specific initiative around all the support work that needs to be done around there as well?
Okay, thanks Janice. A couple of things there. I think that's a good observation actually, and it's really important for us to make sure that, to use your words, we keep pace across the business with the fast pace at the front end, if you like, and with great respect to others that are not at the front end. So, you know, I think certainly 5 years ago, for what it's worth, when I came in, I saw, and people have heard me say this before, I saw a great investment manager. What we needed to become was a great investment management business. And so over the last 5 years, we've put a lot of effort into building out client management capability and business and operational management capability. Witness project. I always forget the name of that project where we spent multi-millions of dollars on systems. Project Endeavour. We have, over the course of the last 5 years, really built out from a great front-end capability, more robust middle and back. So we've established middle offices, we've invested in Investran and VPM, we've changed remuneration policies, we've increased things to try and, you know, build a more robust set of internal systems to keep pace with the current position of the business and the future plan of the business. If there is an explicit focus, it's on the people management as opposed to the operational management, where we have made a lot of investments in years gone by. And Project Best is one of those. We haven't spent time on that today. It is one of the 8 initiatives, but Sahir is actually in our London office today. I think London today and US in the next week. So that's something that Sahir will talk through as one of the more explicit initiatives. So hopefully that sort of to some extent addresses your question. But we're very conscious of the fact that we've got to have great client management. You know, client management 5 years ago, I think we had, I know when we started, we had 3 people, I think, in client management. Today, they're like bloody rabbits up in the GER. Eddie, you can bash me when you come back. You know, all jokes aside, again, we've got a fantastic client base. They've got lots of money with us. We are very important for their portfolios. We've not got to just drive investment returns. We've got to build a broader service proposition, and our GER team now reflects that, both in terms of the number of people that we've got today compared to 5 years ago, and certainly the quality of those people as well as. So, yeah, we continue to keep an eye on the broader operational capability, shall we say, and I think we're well resourced, quantity and quality. Yeah.
And one thing that one of the things that I said to the IAC, which was about the time that we were closing on Indiana, it was a $5.7 billion deal, and we drew 44 clients. We moved cash across 5 geographies, 11 funding banks, and Philip and his team did that without a hitch. It was seamless. It was incredibly professional. We did it without any cash drag, and that kind of support is absolutely critical to getting something like Indiana, which is, you know, just tremendously complicated done in the way it was done. It was a, you know, a tremendously professional job. So I think the team is doing a fantastic job from where they are today.
Very good point. Very good point. Look, we are just slightly behind time, so I recognise that we've all got lots of other things on. Can I just, in wrapping up, say the spontaneous idea for Vina and Kira that we have drinks you know, always looking for an excuse to have a drink. We have drinks in a few weeks' time, but in that ensuing period, have a look at the documentation that you're going to get. Please have a read of it. If there's further questions that you have, by all means ask whoever you want to, myself and the leadership team included. But why don't we also take the opportunity over the next few weeks, we'll set a date up for whenever the drinks are, for you to be able to also email questions in. So when we have those drinks, we'll probably table whatever questions come forward, and then we'll answer them anonymously if people want. at that point in time. So let's set up that facility. But can I also say thank you to everybody? I mean, the business has done a great job over 20 years. It's done a great job over the last 5 years of the planning period. There's a lot to be proud of. It is a fantastic business in terms of the design, a real privilege to be a part of it, in my case to lead it. And it is unique globally, so that's fantastic. We also now have, I think, a tremendous track record of executing to match the superior nature of our design. And you know, as many of us are taught in business school, if you get the design differentiated and the execution first class, you've got a fantastic combination. So we want to repeat that going forward, and the way in which we hope to repeat that is by getting a lot of really good quality input into the business planning process, both internally and externally, sharing that with you through forums like this, making sure that we all understand what success looks like and is defined as, and what it means to me in every respect. And if we do that and do that well, then we have every possibility, as I said at the start, to turn up this time next year and look back and say, wow, that was a cracking year and I'm really pleased about that, and I can understand what it means to me as a result of that. I think we're in a strong position to do that, and I thank everybody for their continued efforts in enabling us to do so. Beyond that, I'll again thank our leadership team. Great team, good fun, but very good at their job, and as a team, very powerful. So we have a great team, a great business, and a unique design. Look forward to the next 12 months and indeed the next era. Thanks, and enjoy the rest of the day.